Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, February 25th, 2020. Quite a bit to cover today, so we'll start out here with TVIX. TVIX, now that trade's closed out, we'll start to talk about that one and the implications it might have for the market. We hit our final target today. This was for a 65% gain on our TVIX trade, and we'll see what happens tomorrow. I'm going to get to the equity index charts in a second. When I added that trade, I have a potential fourth target up here that's still a possibility. But so far we hit the first target, the final target, T3. That was at 79.80. We hit a high today of $80 exactly, and that is 20 cents, which is 1/4%. I'm nailing within the high, and with a pullback from there, of course. So we closed today at 76.43. So we'll see. Whatever happens to the market tomorrow, like I said, you guys, if anyone that's in this trade, you can trail your stops up. But when I closed it out and sent the final update on this today, I said the risk is if the stock market if the futures rally overnight and we gap up, the VIX can gap way down and blow past any well-placed stop. And I'm going to talk about the market here in a second. The market can go either way. We go much lower, what happens is selling begets more selling. More stops are hit on longs, more forced margin call selling. I'll get to a chart of the margin interest here in a second. Institutional investors such as pension funds, hedge funds, they have to take proactive loss prevention measures, risk-taking, rein in the losses. And so what happens then again, selling begets more selling. The only way to hedge up when you're too heavy long and everybody's bullish is you can buy puts, you can hedge by shorting the indexes or shorting individual stocks, or of course sell your positions. Any one of those, all those are just going to lead to additional selling, at least in the near term. So we'll roll into that. But again, nice exit so far. Congrats to those that took that for a 65% ride. And that reminds me of our USO long. We were bullish and long crude oil from the breakout on this bullish falling wedge, or within the wedge. Took it within the wedge, and like the VIX, we had our stops just down here. We never got stopped out. We had a well-placed stop, which we avoided missing, and raised that stop up there, and we hit the second target. We hit that third and final target just last week, right here on, what was it, Thursday? Yep. Thursday, got out at 11:36 with a high of 11:43. Again, close enough for government work there, just a few pennies from the high, reverse and sidestep this big give back. And again, I know some of you on this site shorted, reversed there like I did. Wish I would have stayed short that long on crude, but that's fine. Plenty of money made on the index shorts last couple days, but that's about a 9% give back on USO that we averted there. Some nice exits lately, not to mention the entries. A couple of entries are a little early again, like I said, but as long as they don't get your stops. In trading, I think there's a big difference, and this is just me, between being early and wrong on a trade. Early, you get in early, the trade doesn't play out right away, maybe even you go underwater, but as long as you're not stopped out for a loss and the trade goes on to play out, you're correct and you're early on the trade. Wrong is when you're stopped out. And so we were good on these last two. And now let's talk about the market. That's where the real money's been made lately. And I'll start out with, let's go to the futures. Let's do that real quick. Okay, earlier today, this morning, I'd first laid out some targets, some downside targets, and before the market opened, and then I did an update. This was posted this morning, a little before 11 o'clock Eastern time, in which I highlighted some even more potentially bearish developments in additional downside targets for the market with a more. And what that was, I was highlighting these larger bear flag continuation patterns that had formed. Let's talk about those because those are still in play. They've been playing out really well. So what I'm referring to there is we had this impulsive leg down right here. And I said in that video, you can measure it one of two ways. You can consider that because that was a near vertical drop there. You had a little bit of consolidation. Or you can consider this, that move from the high, because that initial leg was impulsive, little zigzag in there, and we dropped. Either way, one and the same. The only difference is on a bear flag continuation pattern, which here's your flag right here. You have a a period of consolidation after an impulsive drop. Then you take the measured target, which in this case will take that line. You add it to the highest point of the flag before it breaks down. I'm sorry, this is the flagpole, this move here. So, and that would take us down here to about that 8107 level. Let me measure it out for you. I think I did this in the video. That would be about a 6% drop from there, and see how that would take us right down to that 8700 target that I have there. So they are certainly in play. It doesn't guarantee when you have a bear flag pattern that it must play out to the measured target, nor does it guarantee that if it does, that it can't go any farther than that. But you would be surprised how often these things play out perfectly. In fact, I just pointed one out a few days ago, a few trading sessions ago, and that was on QQQ 60-minute chart, and that was right here. Here, let me get rid of all these busy lines here. We had a textbook bear flag right there, and it was on a smaller scale. That's what I mentioned in the video to subscribers on the right side of the chart the other day, earlier today. Impulsive leg moved down. There's your flagpole. Took a measured target, and it was exactly that measured target. It hit both a price target that I had on that chart right there, as well that 230.33 target, as well as a measured target. And again, to get the measured target, what you do if you have a charting program, just draw a trend line like this to the bottom of the flag, because that's where the flag sets up, the flagpole that is. The lowest point right there. There's your bull flag or bear flag pattern, and then you move that line, or you can just click and duplicate the line. Right click, create parallel line, and then you can see they're the same. And so that's how you come up with a measured target. And again, in this instance, like I said, it played out textbook. This is what you want to see, the three components: the impulsive leg down, initial leg down, the flagpole, followed by a period of consolidation that takes an upward move like that on declining volume, then followed by an impulsive breakdown and a roughly equally impulsive move down out of the pattern. And you can see, when I create a parallel trend line, it has the same slope. Now what that does, it tells you not only in points or distance how far down the measure target is, but it gives you an approximation in time. So again, you add it to the highest point of the flag before it broke down, and when you're looking at a sloped line, you have two axes. You have this is your price axis, I should say, and here's your time axis right there. So that gave us a pretty accurate guide there. Now, again, bigger picture is we turn all those lines off, and we have the same thing pointed out today, just to a larger scale in the indexes, as well as many of the market-leading FAANG stocks. That's what I pointed out as well. And that's it. It looked a little better when you put on the pre-market trades this morning. That's when I first showed it. We had a little area of consolidation, but it's pretty clean flags there. And again, that would project to a little more downside coming in around. Let's measure it out for you. Let me find a clean board here. And you know what? I already have a measurement right here. There's a lot of lines on this chart, but forgive me. What I'm going to do is I took a measurement down from the flagpole to that one, and that tells us that we could drop all the way down here to about that 208 level if that does play out. Again, it doesn't have to play out, and as you can see from this chart, we have some support right here. These are all support levels, and but I want to go back to the futures right now. Let's loop back to NQ. NQ is in what I like to call no man's land. No man's land is what I refer to when a security is smack between support, which in this case, next support I have is about 8,700, and resistance. There's that 89.90 target level, pretty big level. It was resistance back here, and so we're a little bit below that now. And again, in between, we have resistance overhead. These were former support levels. Support once taken out becomes resistance, and that support down below. So that would be my maximum target. Now there is a potential bullish scenario setting up, bullish developments, and I use the word potential and I use the word developments because we're in a downtrend, make no mistake about it. There's no signs of a reversal yet. Selling has been very persistent, but as you can see there, I drew these and I pointed these out earlier today, these potential divergences. Just like I talked about potential negative divergences building for weeks and even months now, and then they finally played out and they manifested in the form of a correction, which is taking place right now. So now we have these potential divergences, but what we need to do is we need to turn back up here soon before the PPO and the RSI take out those previous lows right there. And in doing so, if we can make a bullish crossover here on the PPO, reverse up here, regain 89.90, that would be a 88.90, that would be a bullish technical event, especially if we can get above 89.41. That was also support that was taken out. Then you could put in this divergent low on the 60-minute chart, and that could be the catalyst for a nice rally. I mean, all the way back easily to the top of these flags, possibly maybe even a back test of that trend line that I talked about. That was, you know, an additional sell signal recently. That's the trend line. Was that the one off the October 3rd lows? I know we took that out in the Qs. No, this one I have on the futures is the December 3rd low right there. And here's ES for you S&P 500 traders. The divergence still potential. You can see the PPO lines there, but the signal line is still up there a little bit. But you can just see that nice big old bear flag and the impulsive nature so far. Here, we'll draw it out here for you. So you had this area right here. You had the initial leg down, the impulsive move down. Again, you can measure it from there if you want to say, or from the highs there. That just gives you a longer flagpole and a longer measured target. This one comes in about right here. So we're close. And this certainly could be the end of the selling. Now, the problem with the market when you have these sharp sell-offs after, you know, just a one-sided trade where the market's gone up and up with just little corrections along the way, you get excessive sentiment, bullish sentiment, and more importantly than the sentiment, even I'll be honest, I hadn't checked the latest readings, but whether they were very high, just mildly high, what I can tell you is positioning is too high, meaning everybody's long. After the market goes up and up and up, you get that bulletproof feeling, you know, the longs become emboldened, think that, you know, for whatever reason it's different this time, and there you get this rush for the exit, because when everybody's long, this is what happens when everyone tries to sell at once. Selling begets more selling, stops get hit, institutional investors have to then, protect their downside, so they have to sell stocks, even if they don't want to. ETFs and mutual funds, for example, they have no choice. If you own a mutual fund, whether it's in your 401k or any other account you have, IRA or not, or an ETF, when you sell that ETF, you have a redemption. They have to give you that money out of the ETF as soon as it settles. And so therefore, if everyone's panicking now and selling, which tends to happen in these type of drops, the selling begets more selling because those ETFs and fund companies are forced to sell what they own. What do they own? Well, they're chock full of the FAANG stocks: Facebook, Apple, Microsoft, Amazon, and you could see that today and yesterday. Those guys, they bring the market up to the upside when everything's going well because everyone wants to own them and they're buying them. Then that buying leads to more buying, and then it works opposite and reverse. The only difference is, and the reason I love being a flexible trader, going long and short, is, as I often say, the beauty of this is stocks tend to fall much faster than they rise. Here's 1, 2, 3, 4 trading sessions. The market has dropped about, QQQ has dropped over 9.5%, nearly 10%. And as you can see, it's wiped out the last few. We go all the way back to about right here, Tuesday, January 7th. So we've pretty much wiped out almost all the gains for the entire year in just 4 trading sessions. And so that's an example of why you need to be careful and why you need to use stops. There was nothing wrong. I've been looking for pullbacks all along the way, looking for the divergences, because that's all I could do. When your market's going up to new highs, it does nobody no good to, any good, I should say, to say you're in an uptrend and you really don't have any levels to target. But this is where technical analysis shines. At least my style is on the way back down. You have all these levels that were resistance, and we had reactions and trend lines before, so you can target those. And so when I'm looking at this daily chart, I see a pretty important trend line just smashed through. That was the October 3rd trend line I'm talking about there on QQQ. We gap below it. Thought we'd get a kickback rally, but like I said yesterday, I want to see what happens, see how the market followed through, and it showed its hands today. It's like playing, if you're a poker player, somebody sits down at the table, if you've never played with them before, you need to kind of go in and have a few hands with them, and then you get to know their style. Are they an aggressive or a loose or a tight player? Do they bluff a lot? Do they bluff at all? and you get to learn that player. So the market showed its hand today, and what it showed me is the buyers have left the building. Their MIA, the Qs were down another 2.75% today, and SPY was down pretty heavy today too. We saw a lot of selling in SPY. And I think it came up. It was 1 point. I saw it down more than QQQ. Let's see where it closed. Yeah, 3%. So that's unusual to see that. And what it tells me, it was broad-based sell-off. This is distribution. There was a crowded. The bus was too crowded, or the movie theater, whatever you want to say. And so what happens when someone yells fire and everyone tries to run out at the same time. And look at that. We took out that support level with a big red candle today on SPY. So all I can tell you right now is, there's been a lot of technical damage. We're near support, but we're in no man's land. There's still support down below, so we could still see some more downside as oversold as we are in the near term. Do you want to short right here? No, a lot of people do. Nobody wants to short when the market, gives those sell signals on the 60-minute time frames, or very few people do. This is when people feel like shorting, and that's usually about the time it's almost over. All I can tell you is when the rubber band is this stretch, when you drop this much in short order, we are not, actually we are now. Earlier today I did an update and we were not oversold on the daily, but look at that. The RSI has now hit oversold reading, and it doesn't mean we can't go lower, but we were extremely oversold here on the 60-minute chart on the RSI. And so where I was going with that is, when you drop this much this fast and you reach these extreme oversold readings, the rubber band gets very stretched. And the more it stretches, the more it can snap back. So that's an easy analogy. You probably heard that one before, but there's also one more point to it. And I'm not trying to be doom or gloom here. I'm just pointing out what can and sometimes happens. You go back for many years. I've traded long enough. I've been through many crashes, mini crashes, and full-blown crashes. What happens if you stretch a rubber band too far? It actually breaks. It doesn't always snap back. And what that has to do with is things like this. Here's a chart of margin debt. Margin debt, if you're not familiar, when you open a brokerage account, you can either have what they call a cash account, where you can't borrow against your securities. Those IRAs are cash accounts. Or if not an experienced trader, you don't have enough capital, you might not have opened a margin account. Most traders open margin accounts, which allow you to borrow against the value of your securities. In other words, you can put 100,000 in stocks and you could buy a couple 100,000 or more, depending on what maybe many times that if you're trading futures and things. So what happens is a bull market rages on, more and more people pile into margin. They use margin to load up. If you're making 20% a year on Apple, why not double up, borrow on margin, double up and make 40% a year on your money because you're leveraging up. So that's what goes on there. And then boom, and that's usually at some point you get the unwinding of what they call a margin bubble. So you can see this shaded area, that was a recession back then, but there was the dot-com bubble. The red line, if you don't know what we're looking at, blue line's S&P 500, the red line's margin debt, and you can see they coincide and they peak. And then the reason, if you're wondering why was 2008 so bad, they called it the Great Recession, but that recession back in 01 wasn't that bad. What you had is a huge margin bubble. And it doesn't matter how good a company's financials are, how strong their earnings are, how good Apple is, how has a cult following. During the unwinding of a credit bubble or margin bubble, you have forced liquidations. So that's always a real possibility. We had a little peak right there. We had a near bear market. In fact, many indexes had a bear market there. You had a pullback in margin, but look, the bubble has only grown. But it actually peaked. This is unusual. Peaked back here, and it's been falling, and the markets continue to rise. So I just want to say that anything is possible. I'm looking for a bounce coming up. We'll go back to those levels I just showed you, and I think we'll see a bounce soon, assuming the rubber band doesn't snap, because I just showed you margin interest is still just coming off record highs. I mean, highs, levels never seen in history. So that's one of the side effects of the Fed's grand scheme here. And all the central banks pumping the system full of liquidity and keeping rates artificially low for too long. Those are the excesses that many worry one day are going to come back and really have some very bad unintended consequences for the market and the economy when we finally start unwinding that margin bubble. All right, we're not there yet, guys. Look, I'm going to keep this relatively brief here. You still have a lot of key support levels. I talked about this. Let me just go back here to this one. We'll look at SPY and QQQ. This is the bull market right here. This trend line, if you want to use two levels, it is this trend line right here. That's off the 2008-09 lows in QQQ. And you have the 20-month, one of my favorite long-term trend indicators, 20-month EMA on the monthly chart. And it does a phenomenal job of defining bull and bear markets. So we're above both by a comfortable margin right now. So just want to say that at this point in time, although this can develop into anything, right now we can't say it's anything more than just a long overdue correction. Just happens to be a pretty strong one so far, the way it started off. And there's really no evidence at this point that it's over. To me, it's a matter of when we bounce and how far we bounce, and then where do we go from there? There'll probably be more downside. We're starting to break on the daily chart. I'm not going to do too extensive a video here, but I saw a lot of trend line breaks, QQQ, SPY, those market leading FAANG stocks that I like to follow, Apple. Apple coming up on trendline support, at least on this chart here. Microsoft just cracking below trendline support recently, so it's like yesterday. There was a mixed bag. Amazon entered the gap, but came up on this old trendline. I'm not putting too much of a weighting. Alphabet cracked below. See, you have a lot of things breaking support. That's why I don't think this thing is over. Anything is possible. Maybe we kick back, and if we snap back, there should be an objective shorting entry if we snap back and rally into some of the resistance levels above. For example, something like this on Alphabet. I'm just one quick example. I'd have to study the chart further, and then maybe a leg down like that. However, when you get these lopsided or one-sided rallies and all the shorts are blown out, that is one of the side effects of a rally that just goes with very small corrections. Short interest becomes very low. The shorts give up, and then on these drops, the reason they happen, one of the reasons is the shorts aren't there to cover anymore. I love shorting, just like I love going long. But the one thing about a short, I always say this: they're the only guaranteed buyers in the stock market. By that I mean, if you're a long-side only trader, you can speak the bullish speak, and you talk about Alphabet all day long, why fundamentally it's a great stock, technically it's a great stock, why it's going to 2000, and why you plan to buy it, but you don't have to buy it. You might say you're going to, you might intend to buy it, but at no point do you ever have to buy that stock. You may change your mind. If I short Alphabet, I must buy it. I'm borrowing the stock from my broker. I'm borrowing somebody else's shares. They're given to me. And at some point in time, I have to close that trade out. And that is why short sellers, when you have high short interest, that's where you get the short rallies. It also sort of slows a slide in a stock, because if you have a lot of shorts in there, they're going to take profits when you hit these support levels like this. For example, when Alphabet hit that 1422 yesterday, it certainly consolidated on. They had that typical reaction, which usually you do on these support levels, but what happened is there just weren't enough buyers. There weren't enough shorts covering, nor were there enough longs stepping in to buy it. So boom, that support level gave way. And as of now, 1422 or so, 1423, even the top of that high up to about 1440, that's resistance. And then you have the trend line. So this is a stock that's broken down. And look at this chart, especially with the divergent high and everything else, just like the indexes, it says to me, we're going lower. It's just a matter of when do we have the first snapback rally? Is it coming soon? And again, the rubber band is getting stretched, as I mentioned, on those 60-minute charts, and even the daily. Here's Alphabet down close to the 30 level on the RSI. I'm sure QQQ is right there, close to it. Yep, 34. So not oversold yet, or at least not at that 130 level, which is considered, last time we hit it was right here, that was oversold, and that was the best buying op in the last year or so. If you, well, one of the best, I should say. If you stepped in there, you know, the market, it just moved higher from there. Put in a higher low right here. And another level to watch, you can probably see this red line here. Let me turn everything off. Is that 200 EMA. You get a correction like this, anything is possible, but it's you're probably going to come back down and have to visit the 200. The 200-day EMA is a key level at which buyers step in. Even during a strong uptrend, you get ahead of it, you get away from it, and you come back in and visit it. You get away from it, you come back and visit it. We haven't visited the 200 EMA in a long time, so if you're looking for one potential target, I think that's a great target, and it also aligns with price support, which is right here. Let me give you a, yep, there it is. Actually, that level comes in a little lower. That's about 195.55. It's a pretty solid support level. If we keep falling, the 200-day is going to turn down a little bit. So if it took a while, if we had to zigzag down to get there, you know, something like this, maybe a kickback rally soon, worked our way down there, the 200-day could come in right around that level. So there's one potential swing target. But first things first, let's see what happens tomorrow. Okay, and here's a couple levels to look at on QQQ. Support coming up around 214. You know, different drawing boards, I have different levels, but you can see some of the ones here. But when I look at this, these are all support levels that may produce a reaction, just as these former support levels, which have been taken out on the way back up. If we bounce, let me move that to about 218.13, are likely to come into play as resistance. I'll move that one up a little bit there too as well. But ultimately, once you get down here, we broke some pretty good support right around here. And I'm looking at this volume at price histogram over here. We've entered a thin zone right here. You can see these big red bars that come out to right here. Then the next bars are down all the way over here. So from here to here, that's a thin zone. And we're in that thin zone now. And that thin zone, once entered, is likely to be backfilled. Even if we kick back to test the top of it, that could bring us all the way down here to that 205.87 level. That may come in around that 200-day moving average. And I also have a longer-term trend line I can see that goes to the left of the chart here that comes into play there as well. So those are all potential targets. And let me see if there's anything else. Yeah, here we go. We'll look at SPY real quick for you SPY traders on this board here. What happened is we had a lot of support levels that were just bypassed on a gap. So that gap, I talk about this quite a bit too. What it does when you have these, you know, one-sided trades and excessive bullishness, and everyone says, just buy the dip, that's all that works. And, you know, and people finally capitulate, shorts capitulate, and everyone's just buying the dip. They get trapped. You know, they were saying, okay, well, I'll have, you know, if we pull back, I'll have stops. All the stops in this level got bypassed, so they were trapped. So you either had those people finally capitulating, or they may do so if they haven't done so yet, but that's where you get that vicious sell. And then again, like I said, you didn't have really many shorts to cover at that point. And you can see we hit this support here. It's about 312 right there. And you have support down here at about 307.23. So let's just look at this from that bear flag perspective. Let's draw out two measured targets. Let's take we'll call this the flagpole right here. You know, this being our bear flag pattern. How do we want to draw this? This would be more of a bearish pennant. Like I said, it was a little more clear on the future. So there's a bearish pennant. We'll use this, and then this one right here from that high right there. And let's see where these come in. So I drag that line down and put it to the top of the pennant right there. Pennant's a close cousin of bear flag. Brings us down almost to this 307.23 target, and between that 312 where we hit today. And if we take this line, that's going to bring us down. Wait a minute, why did those two not line up? Oh, there it is. I didn't drag this one down far enough. There you go. So that's going to give us a little bit different. That'll probably bring us closer to, if I can grab it here, closer to that 307 target. There you go, right on it. Look at that, right on the 307.23 target. So which one will it be? Well, either one takes us below where we're at now. So I'll have to go with the charts. The trend is down now. There was not any evidence of reversal today. We didn't see any bullish candlestick patterns. Every attempt to rally was just sold into just dead cat bounce after dead cat bounce. Hey, that can all change tomorrow. Maybe Trump fires off some kind of tweet. Who knows what happens? I can't trade around that. That's one thing I cannot, trade anticipating what will be the next tweet or headline. I'll go by the charts here. So as of now, I'm leaning towards a little more downside and then getting ready to cover and reverse and trade a oversold rally if and when we get there and we see that evidence. So let's wrap it up here and we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.